Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same 4 LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices. While we expect 53 to be the next rally staging post, liquidity providers assess $140 silver would provide the most likely staging point to bring sufficient bullion to market.
Something historic is unfolding in the gold and silver markets, and most investors are completely unaware. Veteran metals analyst Andrew Maguire says the system that's kept silver prices artificially low for decades is now collapsing in real time. London's bullion banks, once the center of global price control, are losing their grip as physical silver runs dry. Lease rates have exploded, traders have stopped lending metal, and now China's People's Bank has imposed export controls on silver, choking global supply even further. This isn't speculation anymore. This is a structural breakdown in the world's most manipulated market. Maguire warns that the global silver system is on the edge of default, and once real supply is priced in, silver could rocket past $140 an ounce, not from hype, but from raw physical demand. Let's dive in and break down what's really happening and why this moment could redefine the future of gold and silver ownership.
London has lost control of the global silver market. We said it last time. It is now so clear it's hard to ignore. Unprecedentedly high risk, unfulfilled local London lease fees illustrate both a lack of trust to lend metal into global supply tightness. So, why you can't trust it? It's too risky. These spreads could be closed at any time. And while registered COMEX inventories appear to be in adequate supply, that is enough to cover a rush of delivery demands, really, as it looks at face value. These leveraged CME warehouse receipts are inequitably hedged against an unfactored lack of local London supply. This is why US lower priced US denominated bullion is slow to be shipped out to capitalize on up to a massively, as I say, attractive $15,000 profit per contract. Silver actually should have immediately been flown out last week, last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce. Yet it was very slow to move. And this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price. In fact, the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at, across the board, spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious. It's mind-boggling and yet we listen to Main Street here. I'm on Bloomberg all the time. While they're caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages, with this effect forcing the US silver prices much, much, much higher. The US is the sole outlier and is being targeted. And while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the COMEX registered and eligible stocks into London, this is largely serving to satisfy immediate, unallocated, over-the-counter bets that have been called for delivery into empty local London vaults. It's just really keeping pace, trying to keep pace with an immediate default. Notably, illustrating it takes higher prices to bring silver to market. So it's evident this basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices. Nobody wants to lease this out. And while inbound US silver shipments are serving to relieve some of the EFP basis spreads between the COMEX futures and spot, currently still averaging a deeply backwardated, I'm looking at it right now, averaging a dollar spread. I mean, that's still $5,000. And we've seen it's about plenty of time to have shipped out silver to meet this demand. It's not hard to put 25 tons on a cargo flight. So global physical shortages is really what they're going to do is really quickly absorb anything that arrives in London. In fact, while shipments are serving to avoid an immediate default, the only solution actually is to bring more bullion to market. It would have to be at higher prices because otherwise it's not going to be offered. Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same four LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices.
As of October 2025, both gold and silver are surging. Gold recently touched an all-time high near $4,200 an ounce, while silver climbed above $53, up more than 80% this year. But according to Andrew Maguire, this move is only the beginning of something far larger, a monetary reset built around real metal, not paper claims. He explains that the London Bullion Market Association, the historic hub for global metal settlement, is breaking under stress. Clearing members who once lent silver freely are refusing to do so because the risk of default has become too high. Lease fees, the cost of borrowing physical silver, have skyrocketed, a clear sign that trust in the market has collapsed. While the COMEX in New York still reports healthy inventories, most of those bars are locked inside layers of derivative hedges. They're paper ounces that can't actually be delivered. To avoid default, bullion banks are airshipping metal from US vaults to London, but Maguire says that's only buying time. Every shipment is instantly absorbed by industrial users and sovereign buyers, particularly in Asia. And now China's export controls are tightening the squeeze. The Shanghai Gold Exchange International has emerged as a new global pricing force, with offshore silver contracts being aggressively bid by global buyers. London's dominance is fading fast, and Asia is taking control of price discovery. Maguire estimates that silver would need to reach around $140 per ounce to draw enough physical bullion into the market to prevent widespread delivery failures. He also points out that, for the first time in decades, every major bullion bank, JP Morgan, UBS, ICBC Standard, is now long silver, signaling that insiders expect a historic repricing. His warning to investors is blunt. If you don't hold physical metal, you may not own anything at all. The old system built on unallocated paper contracts is breaking down. This isn't a short-term rally. It's a shift in global trust from paper to metal.
Even into the 1979 to 1980 Hunt Brothers short squeeze, these sort of backwardations did not exist. And whereas the Hunt Brothers backwardations were able to be contained and cash settled inside the siloed COMEX, where essentially that's where the market was, now the price-setting physical liquidity has been captured by the Western-facing SGEI physical exchanges, influencing every other silver and gold foreign exchange cross. And as we previously ascertained, the quarterly OCC reports, the Office of the Comptroller reports, lists the historically accrued, unallocated, unbacked foreign exchange silver derivative bets being stick-handled for the Fed by the two remaining Fed agent banks, JP Morgan and Citi. Now, do you remember we showed the third quarter unwind of the 5-year derivative bets? That was an important point to note. But actually, out of the 4 LPMCL members, that's ICBC, Standard Bank, JP Morgan, UBS, and obviously, so basically, it's only JP Morgan that provides the only LPMCL cartel member that provides the conduit into the OCC derivative bets. So, ICBC, Standard Banks, UBS, and JP Morgan. Now, notably, and by absolutely no coincidence, last week's rushed together proposed OCC rule, there was a rule change. It slipped under the radar. I haven't seen anyone else looking at this. And what it was doing, it was attempting, this was in a legal announcement, which seemed to be missed by all the mainstream media. It was attempting to rein in bank supervision of exactly these kind of derivative risks. And I just made a copy of it. Quote, federal banking regulators unveiled a pair of proposed curbs on their supervision programs that would formally ban the use of reputation risk. Not, what about people that have been fined close to $1 billion for manipulating silver? Forget reputation risk. As an exam factor, so they remove that, and constrain what examiners can call out for criticism as, quote, unsafe or unsound practices. Going to curb it. Why? There's a panic on. The rule would also encompass unallocated FX gold and silver captured in these quarterly OCC reports. However, given there is simply not enough bullion to meet upcoming delivery demands at current prices, it telegraphs a very, very large move higher. As I say, liquidity providers are assessing $140 an ounce for silver just to meet that demand. Forget anything else. And this is why there's been very few offers to lend silver into higher lease rates. Now, while remaining COMEX speculators have largely been cash settled, and you can see they're progressively, we looked at in the charts, progressively they've been rinsed out. Very large predatory central bank sovereign buyers will force backdoor COMEX loadouts, meaning they'll stand there for delivery, forcing LPMCL actors in related COMEX to buy back these asymmetrically imbalanced bets at substantially higher market prices, further tightening global supply, driving the global price, as I say, much, much higher. So in summary, with every single bullion bank long silver for their own books, every single FX currency bar the dollar higher, these unbacked FX silver liabilities undoubtedly sit on the Fed's books. There's just no doubt. And hence the defense of these very large, asymmetrically imbalanced, naked short COMEX hedges that have been left exposed by physical silver and gold being benchmarked against a real global supply-demand price outside the control of the LBMA CME cartel's ring fence. It is this physical market liquidity that is forcing a real supply-demand settlement price to emerge, and it's only just starting to emerge. These official silver futures short stops have sat at the prior silver all-time 2011 highs. We looked at that. And we've seen multiple attempts to defend these short bets with very little speculator open interest able to be rinsed out, which is currently being attempted every day.
Andrew Maguire's direct message to gold and silver investors is simple yet urgent. Don't rely on promises. The paper system that once controlled prices is cracking, and the new era will reward only those who hold the real thing. If silver breaks through $53 and moves toward $140, it won't just change the price of a metal. It will redefine value and credibility in the entire financial system. Gold is confirming that shift right now, but silver will be the spark that exposes the gap between paper wealth and real assets. So, here's the question for you. Do you believe silver's breakout is just starting, or are we already in the early stages of the Great Silver Reset? Drop your answer in the comments. If you value real analysis, not Wall Street spin, hit like, subscribe, and turn on notifications so you don't miss the next big update. This is Metal Watch, bringing you the truth behind the charts, because what's coming next in gold and silver might just shock the world.